A very good evening and a warm welcome to Personal Finance. I'm Kukuletu Cele. According to Old Mutual Wealth, South Africa's middle and upper class earn more than enough to afford comfortable lifestyles, but do not realize that a trade-off is required to ensure that their lifestyles are sustainable. Andrew Bradley, Chief Executive of Old Mutual Wealth, joins me now for a look at 5 steps to sustainably grow your wealth. Andrew, thank you so much for joining us this evening. A pleasure to have you with us. So the key question, or the key issue quite clearly, is that everybody can afford to live a very comfortable lifestyle, but there are typical mistakes that we often make in pursuit of competing with the Joneses. Where do we usually fall off track?
Well, I think the first thing to stress is this survey and research was done for people who earn more than 80,000 Rand a month. So it's not certainly below the poverty line. So from that perspective, that category of people certainly should have enough. But quite frankly, at the moment, they're living beyond their means. And that's the beginning of most of their problems. They're simply spending more than they're earning.
Just on that, what are the typical mistakes that they make? Is it taking on a credit card that has a limit which is too high for you to be able to handle, getting a bond which is a lot more expensive than what you actually can afford? And is there a false perception of financial security, especially for individuals who earn that level of income?
I think the mistakes people make are right across the spectrum. But I think the first and most important thing to do is make sure that you sit down and actually just do the basics, and that's a budget and knowing what's coming in and knowing what's going out each month. And right now, unfortunately, one of the many problems people are sort of having for themselves is that, as you correctly say, they're incurring too much debt, whether that may be in credit cards or overdrafts or whatever it may be. But right now, people have got far more debt than they should have. We're in a slightly better position than we were a few years back, but still we are living way beyond our means, and debt being a critical component of that. I think the other aspect is not thinking of the future. So this is just right now. People have got a problem with spending more than they're earning now, and I think if you look into the future, they're not saving for that either, which is going to exacerbate their challenges in retirement. But right now it would appear also that people are trying to live and have as luxurious a lifestyle as they possibly can without any consequence. So it's important for us just to take that reality check and see how much we are earning and how much we're spending. That doesn't mean that one should live a miserable life now and just save for the future. You should obviously make sure you live as happily as you can. And I think there a concept of hedonic arbitrage is an important one. And what that simply means is, how do we have more fun for the same amount of money, or we have the same amount of fun and happiness for less money? And I think for each and every one of us, that's an important thing that we should reflect. Where and how we're spending our money, and how can we live those meaningful and fulfilling lives without necessarily spending more money.
Andrew, it's interesting you mention that, because you also make mention in the report that income doesn't necessarily equate to wealth. But walk us through the first step of trying to generate wealth, and you highlight the fact that one needs to focus on time in the market and not timing the market. Could you elaborate further?
Yeah, I think the first step, as I said, is making sure that you've done a budget and you have some money to save for the future. And then once you embark on that journey and go about investing for the future, it's important to understand that what's going to give you the best returns in the long run is by investing and sticking through for the long term. Many people make the big mistake of, once they start investing, looking to get in and out the market, because from an investment point of view, the stock market mostly goes up, but at times there are periods where it does come down, and how we behave in those times are as important as how we behave over the long run and sticking into the investment. So all our research indicates that those people that try and go in and out the market invariably destroy wealth. So we're seeing investment markets performing well, but most investors failing, because they get in at the top out at the bottom, back in at the top, and so we go on and perpetuate that problem. So time in the market and not trying to time yourself in and out is what is critical.
What about understanding the time horizons and the risks that might be associated with this? And is it important, obviously, to have different portfolios stretched out over different time targets?
Absolutely. The period of time that you're investing for will have a major influence on where and how you go about investing your money. So as an example, if you're saving money for an overseas trip at the end of the year, where you invest that should be very, very different to where you're investing for your retirement, which may be in 10, 20 years' time. So, if you're saving for your overseas holiday at the end of the year and you put your money in shares and the stock market might come off 10% towards the end of the year, that's going to have a serious impact on whether you have that overseas holiday at all. So understanding how long you're going to put your money away for will dictate to a very large extent where and how you can invest it. So that is a very important first step.
Andrew, something that's also a common phenomenon when it comes to trying to generate wealth is diversification, diversification, diversification. Number one strategy, obviously, for one to employ when it comes to creating their wealth.
Yes, I think if you know exactly what you're doing and you are prepared to increase your risk dramatically, then put all your eggs in one basket. But should that basket be involved in an accident, all your eggs will be broken, and that's obviously very, very dangerous for the long term. So the best way to get around that is to diversify. Now, diversification can take place at a number of levels. So, is all your money in shares, or is some in shares and some in property and some in cash? And then, even within the share market, is it all locally, or have you got some locally and some overseas? And then again, are they all in banking shares or all in IT shares, or are they spread across a number of different industries? So it's very, very important that you have a well spread and well diversified portfolio to make sure that irrespective of what happens, and none of us can tell the future, unfortunately, but whatever scenarios are likely to play out, that your portfolio will be best protected and geared towards that in the future. So all your eggs in one basket, an incredibly risky approach.
Mm-hmm. You're quite right there, but how often is it, or rather, Andrew, how important is it for individuals to review their saving or investment process? We recently heard the finance minister making the announcement of the tax-free savings accounts in South Africa, which have been highly publicized. I understand Old Mutual itself also has a few offerings to consumers. Are these new products and new elements and new product tools available something that investors need to consider in an attempt to continue generating new income?
I think an important aspect of any investment strategy is to have a sound framework within which to make your decisions. And then on an ongoing basis, go through that framework and review where you are, where you're going to, and how you are progressing on that journey. And an annual review of that is critical. And the key reasons for that is your circumstances are going to change over time. The environment's going to change and legislation will change. And you've just mentioned a very good example. So, a year ago, you could not invest in a tax-free savings account, which, even if your investment portfolio is exactly the same, by just putting it in that structure, you get various tax benefits which the government is giving you. So it is absolutely silly not to take full advantage of those. And the other thing is investment markets are going to change over time. So just taking stock of where you are and where you were a year ago and what you're trying to achieve in the future is very important. So within that framework for how you make your investment decisions, it's important to review it to make sure that you are still on track. That doesn't mean that you should make wholesale changes and throw things out unless there are those changes from a legislative point of view or in your circumstances then you make changes, but not just for the sake of it because the market might have gone up a bit or down a bit. Make sure that you're doing it within a sound framework.
Well, we've said quite a bit, and I'm sure many people are anxious to begin their journey to wealth creation. In a moment or two, we hear from Andrew as to what the key takeaway points from this evening's show are for you to pay attention to. Well, Andrew, it's that time of the show where we find out what your key takeaway points are. I'm sure you've actually touched on quite a bit of them on a more in-depth perspective, but what are the final key takeaway points and the tools that individuals need to be aware of in pursuit of wealth creation this evening?
I think the most important issue is to understand your values and who you are and what you are and what you're wanting to achieve. So once you've got that, you've got a framework within which to evaluate your investment. So that's step one. Once you've done that, make sure you clearly understand where you are now and where you want to go to. And then the next step is to make sure that you have a sound framework for making that investment decision, and that puts you on track for that. And then I think the final and very important step is making sure that once you've put your investment strategy in place, that you have the ability to prevent your emotions from corroding that framework, so that you stay the course, stay invested, and are very clear that you are still on track to achieve your end objective. And that, in many ways, will give you the greatest success and probability of success.
Well, that's it for Personal Finance this evening. A big thank you once more to Andrew Bradley, Chief Executive of Old Mutual Wealth. Just to recap those 5 points to substantially grow your wealth: focus on time in the market rather than timing the market. Understand the time horizons versus the risk to your particular investments, and also diversify your portfolios. Don't keep all your eggs in one basket. Keep investing over the long term and ensure investment strategies are customized for specific needs. Well, do remember that we'd love to hear from you, and tell us if any of these insights have helped you create wealth over the beginning of the show. You can tweet any of your comments to @CNBC Africa using the hashtag Finance410, or to myself @Gukumfupi on Twitter.